Hello, Ryan Mitchell here, Head of Funds at Performance Property. I'm here today with David McMillan, Director of Performance Property, and we're here today to talk about the Performance Property Residential Growth Fund No.1. Before we get into the presentation, I must read a disclaimer. This advice is general and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to invest in our fund, you should obtain and read the information memorandum. So, as I said, we're here today to talk about our first residential growth fund. This is a diversified residential property investment, and we're going to be looking at assets in growth markets that our research team has identified as having, potential for really strong capital growth in the short to medium term. David, would you like to talk a little bit more about the Performance Property and its history and who we are?
Sure. Yeah. So Performance Property formed in 2013. There's about 30 qualified property advisors across the business giving advice to buy property, buying property. We've also got property management team, and recently we're obviously syndicating property. That's what we're here talking about. What our business does is we build property portfolios, and that involves putting a strategy together. It involves buying residential, commercial property. It involves managing those properties and giving our clients guidance throughout their property portfolio journey.
Thank you. So let's talk a bit more about the fund, the residential growth fund that we're here to talk about today. David, do you want to give a bit of an update on, I guess, the current market, what we're seeing in the markets across Australia and why it is we're launching this fund right now?
Yeah, sure. So what we've been doing over the last 10 years is we've been researching the market. And in fact, the business started as a research business before we started acquiring and managing real estate on our clients' behalf. And over that journey, we've been innovating in our research department. We've spent millions and millions of dollars buying data, analysing data, improving the way that we look at data. And over that time, we've sort of identified patterns. We know that markets move through cycles, and we've invested heavily in understanding when markets are about to jump. So at a very macro level, what we're experiencing Australia-wide is a housing shortage, and there's multiple reasons for that. But the overarching reason at the moment is that in many areas of Australia, it's not feasible for developers to produce stock. Why? Because construction prices have risen, and property prices have not risen sufficiently to justify engaging with those construction prices and building speculatively. So a lot of the building that you're seeing across the country at the moment, Ryan, is owner-occupier led, right? And so that presents an opportunity when you think about property from an investment point of view, because essentially every market and undersupply that exists right now is only getting worse. And in certain markets, certainly the ones that we're targeting, it's getting to a chronic undersupply point. And the only outcome that is guaranteed is rising rents. And then at some point, that will force rapid appreciation of house prices and apartment prices. And they are likely to appreciate back to replacement cost. And then you have that last little bit of FOMO, which is where there's a lot of market euphoria because the construction industry is firing. Every industry that feeds off the construction industry is firing. And then you have a lot of enthusiasm in the market, Ryan. And that's really what we're trying to capitalize on here.
Great. Thanks, David. Can you talk a bit more about the fund itself, what it is we're targeting in terms of our target returns, some of the things you just touched on then around the capital growth that we're expecting to see in these markets and what the quantum of that is and over which period?
Yeah, so this is really an opportunistic fund. We think there's going to be sort of hockey stick performance. So you've had really long stagnations. It's going to turn into a market that certainly outperforms inflation in a very rapid period of time. So we're thinking somewhere between 50 to 100% capital growth is very realistic in a short time frame. That's why we're launching this fund. It's opportunistic. It's probably not something that we're going to do 3 years from today or 4 years from today. It's a moment in time fund because of the stage of the cycle. There will be moderate gearing in the fund, so maximum LVR of 50%. To mitigate that, we'll have a cash buffer of 8% of borrowing costs, which is consistent with what we do with our private clients. The target internal rate of return is 14% after fees, and that return is almost entirely driven by capital growth.
Yeah, I think that's an important point, because one of the things that we've done in setting this fund up and the gearing that we're going to adopt is really trying to have minimal income distribution through the carry period, but some leverage in the fund to enhance the capital appreciation that we're expecting to see on these assets.
Yeah, that's right. It's not suitable for those that are looking for income for obvious reasons. We're not going to be delivering much, if any, income, but it is suitable for those that are looking to get performance in one of the best taxation environments, which is generating capital growth and getting that access to that capital gains tax discount. So we're pretty excited about it. As you know, we've been sort of planning behind the scenes for about 6 months. A lot of the team, personally, are very keen to get into this, as well as ourselves.
So, Dave, you've already talked a bit about the macros and what we're seeing in the market. Can we delve a little bit deeper now and talk about, I guess, some of the performance property smarts behind our investment strategy and how we identify these markets that we think are going to go on a run?
Yeah, sure. Well, I think the first thing to appreciate is this is going to be diversified. So it's not going to be one property. It's going to be somewhere between 8 and 15 properties, and that depends on how much money we raise too. Like if we raise a lot more money than what we're thinking, it'll probably be more. The type of property that we're going to be buying is going to be an established piece of real estate. Could be a house, could be a unit block, could be a house that's a development site in an established suburb of a market that we believe will have rapid appreciation. The markets that we believe that will have rapid appreciation, these will be the characteristics. They'll be trading at a very large discount to replacement cost. Therefore, there'll be no speculative building going on, because developers won't be building speculatively because they can't make profit. That will result in aggressive rental growth. And at some point, that rental growth will force the market up in a very contained period of time. This is consistent with what we've seen throughout the last decade when we've gone into various different markets. And those that are clients of performance property over that period of time will have experienced that personally with their own individual properties. This fund, what's different about it is we're probably going to participate in markets that we wouldn't take clients to directly because they're either too small or they carry a little bit too much risk from an individual perspective. But of course, once you diversify and once you remove from the day-to-day management of that property, I think investors will enjoy the returns that they see at the end. So the summary is the market needs to be trading at a meaningful discount to replacement cost. That will normally mean that there's an undersupply already. That undersupply will get worse because no one's speculatively building. That will result in aggressive rental growth. It already will be resulting in aggressive rental growth because we already know the markets that we're going to get into. Rental growth will continue until such time as the market moves past replacement cost, which is where that capital growth is going to come from that we're talking about.
Yeah, and just on the final point, David, can you talk a bit about affordability and what that means in terms of the markets that we look to invest in?
Yeah, so look, a discount to replacement cost is one of the key metrics, but the other thing that we do look at is affordability, and the market needs to be affordability. It needs to be affordable from a debt service point of view, because even if it's trading at a discount to replacement cost, if the market wasn't affordable from a debt service point of view, you could argue quite strongly that the market will struggle to grow. So we're looking for the combination of discount to replacement cost, rapidly rising rents, and also the market being currently affordable.
Okay.
Yeah.
Great. Thank you. Probably going over some of the stuff we just touched on, Dave, so we can maybe go through this quite quickly, but the property clock is something that Performance Property has used for many years now. But can you just touch a bit on this slide here? Yeah,
when we describe this to clients, we usually say that markets go through cycles. There's a price expansion phase and then a price contraction phase. The price expansion phase is the green and the price contraction phase is the red. Usually those cycles are 6 to 9 years on the way up and they're 4 to 7 years on the way sideways. The markets that we're looking at going in now are the more cyclical markets than the capital cities, right? And therefore how they usually present is 4 to 6 years on the way up. So doubling event in 4 to 6 years. And historically, in a lot of these markets, a tripling event or more in 4 to 6 years, and then 10 to 14 years on the way sideways or down, right? So we are moving into the more cyclical type markets. These are the markets that are on right now. Performance property, role for our clients is to take them to opportunities where they are going to make money, and obviously manage the risk through that process. So the cycle is certainly still relevant for where we're going. It's just a little bit different than the capital city cycles that we've been describing to clients for some time.
Great. And then demand versus runway. I know this is another one we use internally a lot. Can you just touch on this one briefly as well?
Yeah, so this is the evolution of the clock. One of the things that the clock has never been able to communicate effectively has been the demand or the velocity that prices may run at because of the pent up demand. So the demand score is some unique IP to our business. It encapsulates stock on market per population. It encapsulates 36-month rental growth, current vacancy rate forecasting, dwelling approvals, population forecasting. So it's a very intelligent measure of where demand is right now and how intense things are in the market right now. And then runway is the amount that we believe, the amount of growth that we believe is left in the market this cycle. So what we're clearly trying to achieve when we're going in and buying properties as part of this growth fund is going into markets that have incredibly high demand and incredibly long runway. And obviously internally, this graph would show all the geographic areas and where they are across the country right now. We rarely release this information. It's very close IP to our business. And so the markets that we're going to be buying into on behalf of the fund will be in that top right quadrant there, Ryan.
Great, thank you. Some examples. So we'll just touch on a couple of transactions that Performance Property has done for direct clients in the last couple of years. Dave, do you want to touch a bit on these just for a moment?
Yeah, so as I've chatted about the fund to a few people, they're like, well, what is it? What do the physical assets look like? So I think it's really important for us to tell you what is going to be the makeup of the fund. This is a unit block in Applecross, Perth. It's no secret that we've been in Perth for a long time, last 3 or 4 years. Perth is a classic example at a capital city level of what we're trying to achieve with it, which is a cyclical market that's been through a very long stagnation, has an undersupply. The undersupply is set to get worse, rapidly rising rents, and we're really just trying to get on that train. This is a unit block that we bought in that market for 3.8. We could sell it tomorrow separately for 5.2, but we're not going to do that because it's still got a lot of runway left. Strong net returns from a residential perspective. And this is what we're really trying to find on behalf of the fund. The reason why we're not recommending this for clients, although some clients are suitable for it, is primarily price point driven. Not too many clients can buy a $3.8 million unit block, but this is a sensational deal for an investor. So one of the ways that we've tried to approach capitalizing on these deals that we find is obviously put them into a fund and then allow many people to participate.
Yeah, and I guess just to that point, the minimum investment for the fund starts from $100,000. So from a price point of view, as David said, 3.8 is a big number. But for those who have some capital available, they can still get access to opportunities like this one, with a much smaller amount of capital. Here's another example. This is a standalone house. David, do you want to talk a little bit about this one as well?
Yeah, so as well as the unit blocks and development sites, for that matter, that we put into this portfolio, we will be padding it out with the normal, bread and butter deals that we do. This is a classic example of something that we bought that we would buy in a regional town, very strong gross yield of 6.3, and that will be characteristic of the returns, the gross returns that we'll see from that property in 12 months. We've seen rapid price increase, and we expect that to continue for some time. And the fund to look like, 3, 4, 5 unit blocks, 3, 4, 5 normal properties, 2, 3, 4 development sites, diversified across these very cyclical areas. with a 4 to 6 year horizon, delivering a really strong IRR to clients.
Great. That's it, everyone. Look, thanks for your time today and listening to David and I talk about the Residential Growth Fund. This is launching in August, and you'll all get an email from Performance Property with further information. If you're interested in the fund, get in contact with your advisor or one of the contact emails up on the screen now.
Thanks, Ryan.
Thanks a lot, David. Bye.